What if I told you Wall Street's best-kept secret is buying a dollar for 50 cents? Value investing has historically delivered 12 to 14% a year. Growth stocks, only 10 to 12. And that gap, compounded over a lifetime, is the difference between a comfortable portfolio and a transformative one. Today, we're hunting undervalued stocks. Stay with me because this changes everything. Here's the core idea. A stock's price, that's just whatever the market says right now. But intrinsic value is different. It's the present value of all the future cash a business will generate. When those two numbers split apart, opportunity knocks. But here's the trap. Cheap is not the same as undervalued, and practitioners say that distinction is everything. This discipline traces back to one man, Benjamin Graham, the father of value investing. He built formulas to estimate intrinsic value from current earnings and expected growth. His big lesson: demand a margin of safety. Buy a dollar's worth of value for 50 to 70 cents. And his star student, Warren Buffett, carried that torch even further. Buffett evolved from cheap stocks to wonderful companies at fair prices, protected by durable advantages. Now, if markets were perfectly efficient, bargains would never exist. Luckily for us, Wall Street springs leaks. Leak number 1: market neglect. Small-cap stocks get ignored by institutions entirely. Big investors simply can't build meaningful positions in tiny companies, so pricing inefficiencies survive. Leak number 2: sector pessimism. Think energy producers during an oil price slump, or banks during Federal Reserve rate anxiety, or retailers during e-commerce disruption narratives. Even fundamentally sound companies get swept down to unjustified discounts. Leak number 3: temporary earnings distress. One bad year can tank a solid company's shares. The common thread? Value hides in boring, overlooked, temporarily out-of-favor corners of the market. So what's in the value hunter's toolkit? Let's start with quantitative screening. The classic filters: APE below 15, APB below 2, and dividend yields of 3% or higher. Plus strong cash flow and low debt. Simple, time-tested starting points. Graham's formula ties a fair PE multiple to expected growth and to AAA corporate bond yields. Then there's Greenblatt's earnings yield, EBIT divided by enterprise value. Here's why it's so powerful. Say the 10-year Treasury yields 4.5%, and a stock's earnings yield is 9. You pocket a 4.5% equity risk premium. Nice. But if that yield sags to 3%, the market is flashing overvaluation. Then there's free cash flow yield. It cuts through accounting noise to measure actual cash. Readings above 7 to 8% flag potentially substantial value. No single method works everywhere, so the pros combine several models because each captures a different dimension. But numbers alone never tell the full story. Enter qualitative judgment. A durable economic moat, brand power, network effects, switching costs, these protect future profits. Buffett's ill-fated Dexter shoe acquisition warns us what happens when you underestimate competitive threats. Management quality, capital allocation skill, and governance matter enormously. And significant insider buying reported to the Securities and Exchange Commission signals real confidence. The end game? Estimate intrinsic value, then compare it to the market price. Comparable company analysis, benchmarking multiples against industry peers, is the most practical starting point. And because every valuation rests on uncertain assumptions, demand a 20 to 30% discount. Now zoom out. In America, the value versus growth pendulum swings with the Fed's policy cycle. Value historically outperforms when rates are high or rising, and inflation is elevated. It also shines when the economy recovers from recession. Meanwhile, growth stocks dominated the low-rate, tech-fueled era from 2010 to 2021. But over long horizons, value has delivered roughly 12 to 14% annually. Buying dollars for 50 cents works. Now let's dig into the academic evidence. Because this premium has survived decades of scrutiny. The long-run scoreboard reads, value at 12 to 14%, growth at 10 to 12. Value tends to outperform over 10 years or more, exactly the horizons that matter for retirement savers. Here's the key distinction. Value investors profit from the asset's own cash generation, not from reselling to a more optimistic buyer. Time, not the crowd, does the heavy lifting. So where do mispricings hide? National Bureau of Economic Research has answers. Abnormal returns persist in hard-to-value firms with low analyst coverage. Information asymmetry, not fundamental weakness, explains much of the discount in overlooked securities. The most persistent mispricings cluster below roughly $300 million in market cap. Contrast that with Apple. In late 2022, about 26 analysts tracked its earnings. Every anomaly gets identified, modeled, and traded within hours. There's little left for you. Value migrates to where the spotlight isn't. The premium is also harvestable systematically. Greenblatt's magic formula ranks stocks on earnings yield and return on capital. A free public version lives at magicformulainvesting.com. No subscription needed. Earnings yield is EBIT over enterprise value, which normalizes for capital structure and tax rates. So a heavily indebted company can't masquerade as a bargain. When Graham's framework and Greenblatt's screen converge on the same conclusion, that itself is evidence. But here's the caveat. The premium is real, yet it's no metronome. Growth dominated from 2010 to 2021, fueled by low Fed rates and tech disruption. Value reasserts itself when rates rise, inflation climbs, recessions end, and volatility increases. Even Graham's formula scales value by AAA bond yields, richer when money is cheap. The post-2022 rate environment reminded everyone, dormancy and resurgence are one cycle. So why does the premium refuse to die? Because institutions avoid the boring, the unfashionable, and the battered. Peter Lynch cataloged exactly those categories as fertile hunting ground. Seth Klarman mined 6 to 12-month worst performers lists, exploiting the very same reflex. Markets extrapolate recent pain, pricing temporary setbacks as permanent deterioration. The discount endures because harvesting it requires doing what Wall Street won't. One honest caveat. Cheapness alone isn't opportunity. Screens generate candidates only. Fundamental analysis decides whether it's a genuine bargain or a value trap. Recognition typically requires 2 to 5 years of patient holding. The premium isn't a free lunch. It's compensation for uncertainty, unpopularity, and waiting. Next up, fundamental analysis. Screening tells you where to look. This reveals what you actually found. This is what separates a genuine bargain from a value trap, a stock that's cheap because it deserves it. Graham's formula: intrinsic value equals EPS times 8.5 plus 2G times 4.4 over Y. EPS is trailing 12-month earnings per share. G is expected 5-year growth. And Y is the current AAA corporate bond yield. Graham assigned a no-growth PE of 8.5, then added 2 points per percentage of growth. The bond yield adjustment bakes interest rates straight into valuation. Low rates mean richer valuations. When yields climb, valuations compress. For Fed watchers, this old formula feels remarkably current. It shines for mature, stable businesses with predictable earnings. But it falters with negative earnings, cyclicals at peaks or troughs, and high-growth tech. Now the stock versus treasury showdown. Greenblatt's earnings yield, EBIT over enterprise value. Enterprise value is market cap plus debt minus cash. Leverage gets properly punished. 10-year treasury at 4.5%. Stock earnings yield at 9%. That's a fat premium. At 3%, you're paid less than a government bond for taking more risk. Flashing red. Free cash flow is far harder to fake. It measures actual cash left after capital expenditures. FCF yield equals free cash flow per share divided by share price. Above 7 to 8%, that cash funds dividends, buybacks, debt reduction, or reinvestment. Free cash flow equals operating cash flow minus capital expenditures. Both sit right on the cash flow statement. A company can report positive earnings while quietly burning cash through heavy capital requirements. And depressed earnings can mask robust cash when the drag is non-cash charges like depreciation. FCF yield is perfect for spotting undervalued mature businesses spinning off predictable cash. The classic checkpoints: PE below 15, PB below 2, 3% dividend yield, low debt. Screen for temporary problems, not permanent decline. Value hides in the overlooked. But gorgeous metrics can disguise a value trap. Qualitative judgment provides essential context. Cheap for a reason. Dexter's shoe lacked a moat and couldn't maintain profitability. Assess management, track record, strategic clarity, capital allocation, ethics. Honest leadership is an asset. Insiders buying with their own money is one of the most compelling signals there is. These trades must be reported to the SEC and tracked through financial data providers. Insiders sell for many reasons: diversification, personal needs, but substantial buying signals genuine confidence. Governance red flags: excessive executive pay, boards lacking independence. Don't ignore them. Each method captures a different dimension. Graham on worth, Greenblatt on cheap plus quality, FCF on cash. Graham suits mature businesses. Earnings yield enables cross-company comparisons. FCF suits cash compounders. The payoff is Graham's margin of safety, $1 of value for 50 to 70 cents. Returns flow from the asset's own cash. Do the analysis well, and the crowd's opinion becomes optional. Ask 10 analysts what a stock's worth, and you may collect 11 answers. Valuation compares intrinsic value against the price flashing across the NYSE or NASDAQ. Graham called the margin of safety the cornerstone of investment success. Most practitioners demand a discount of 30 to 50% before committing capital. The PEG ratio, Peter Lynch's lens, divides a stock's PE by its growth rate, Below 1 suggests genuine value, but only if the growth estimate is reliable. The toolkit runs deeper. Discounted cash flow analysis, projecting cash flows back to present value. Fair PEE multiples, refined price-to-book, dividend discount models, and sum of the parts analysis. Classic benchmarks, PE below 15, PB below 1.5 to 2, debt to equity under 0.5. Judge every metric against industry peers and historical averages, never in isolation. A stock flagged by several independent models beats one clearing a single hurdle. The Alpha Stocks platform automates Graham's calculation across more than 1,500 stocks. With sector-specific adaptations for banks, REITs, and utilities. Graham's model is weighted 45% of its value axis, Greenblatt's at 30%. For investors willing to do the math, the market's mood swings become an invitation. Now, stock screening. What once needed a Bloomberg terminal now fits in a browser tab. Think of a screener as a metal detector on a crowded beach. It beeps constantly. Most of what it finds is bottle caps. Screens generate candidates, nothing more. The challenge isn't primarily analytical. It's attentional. Once a stock hits every analyst's radar, competitive bidding erases the discount. Apple had roughly 26 analysts tracking estimates, every report dissected in real time. The odds of spotting a discount under that spotlight? Vanishingly small. The screener's real job: march you away from the spotlight and toward the shadows. Step 1. Define your hunting ground. U.S. markets are the most covered in the world. Small and microcap names are better hunting grounds, where neglect creates inefficiency. Step 2. Valuation filters. APE below 12 is deep value in most sectors. Below 15 is cheap, below 20 is moderate, still fine when paired with high growth. Trailing PE uses past earnings. A recovering company looks expensive on trailing, cheap on forward. EV over EBITDA is the capital structure neutral champion for comparing companies with different debt loads. Below 8 is generally cheap for industrials and consumer names. Below 6 is deep value. PB and FCF yield round out the filter set that consistently surfaces candidates. Why reinvent the wheel? The legends already published their blueprints. Claremont pulls 6 to 12-month worst performers, then overlays balance sheet strength and normalized earnings. Here's the plot twist. A one-off cost or restructuring charge distorts trailing earnings. Investors examining normalized earnings find genuine opportunities in exactly these situations. FinViz, Guru Focus, OTC Markets Group, and StockAnalysis.com operationalize these methods. The screener hands you the map. The digging is up to you. Numbers open the door, but they rarely tell the whole story. Mediocre ratios with a fortress-like competitive position can prove remarkably resilient. Dazzling ratios atop a fragile business, a value trap waiting to spring. The essential question: what stops competitors from eating its lunch? Managers who allocate capital patiently and transparently can be worth a premium. Insider buying gives ordinary investors a revealing window into the C-suite's convictions. Governance keeps management aligned with shareholders. Accountability, fairness, transparency. Excessive executive pay and weak board independence are red flags anyone can spot. The master's checklist, an understandable model, a real moat, competent management, and why is it cheap? Temporary problems at a well-moated business mark the genuine article. Value isn't one method. It's a family, each with its own champions. Buffett evolved toward wonderful companies at fair prices, built on the moat, brand power, network effects, switching costs, cost advantages. Moats compound value for decades. Greenblatt hunts companies that are simultaneous esprit d'être and good. Earnings yield plus return on capital. Sherman starts where most refuse to look. The past 6 to 12 months' worst performers. Buffett, Lynch, Klarman, Greenblatt, different mechanisms, one shared target. Professional neglect. A practical hunt proceeds in 4 steps. Let's walk through them. Step 1. Screen for low PE, PB, or PEG, targeting out-of-favor sectors. Step 2. Check key ratios against industry averages and history. Eliminate red flags like excessive debt. Step 3. A qualitative dive into the model, the moat, management, and insiders. Ask why it's cheap. Step 4. Estimate value and demand, a 20 to 30% margin of safety. Graham called it the cornerstone of investment success. Most practitioners require 30 to 50%. Intrinsic value is always an estimate. Identical information yields different conclusions, hence the margin. Now the great debate. Value versus growth. Let's compare them head to head. Value stocks usually pay dividends, 3 to 5% yields. Growth reinvests everything. Value offers lower volatility and downside protection. Growth brings big swings. Value thrives with high rates and recessions. Growth loves low rates and innovation waves. Value takes 2 to 5 years for recognition. Growth can pay in months or never. Value's margin of safety is high. Growth pays for a future that may not arrive. Long-term, value returned roughly 12 to 14%. Growth, 10 to 12. Famous value practitioners: Buffett, Graham, Klarman. Growth's champions: Peter Lynch, Cathie Wood, Philip Fisher. But refuse the false choice. Even Buffett counts Apple, a growth stock, as his largest holding. Here's a thrilling paradox. The challenge is attentional, not analytical. The real question: how do you build a pipeline of ideas before the crowd arrives? Apple's 26 analysts per Yahoo Finance dissect every report in real time. Dense attention narrows the price-value gap. Absent attention lets it persist for years. Value doesn't concentrate at the center. It migrates to the edges. Howard Marks of Oak Tree Capital framed it in 2024. Search where others aren't looking. Unpopular sectors, distressed credit, low enthusiasm regions, the most fertile hunting ground. 4 legends, 4 distinct doors, 1 shared logic. Fish where professionals are absent. Graham's distinction: a speculator needs a future buyer willing to pay more. A value investor profits simply by holding and collecting cash flows indefinitely. Unpopularity, obscurity, unfashionability, not warning signs, hunting grounds. Lynch formalized this in One Up on Wall Street, cataloging what institutions avoid. Inefficiencies ebb and flow with the market tide, and the Fed is a powerful current. Graham's formula mechanically compresses fair values as yields rise, linking bargains to rate cycles. The critical question everywhere: temporary problems or permanent decline? Insider buying, management quality, and governance can tip the scales. Inefficiencies reward those willing to look where others won't and verify what they find. Finding an undervalued stock is half the hunt, the other half waiting for Wall Street to notice. A bargain price guarantees nothing. Stocks can languish below value for years. A catalyst, an event, or a perception shift closes the gap. Your job: spot the sparks early. Cash is the loudest language. Dividend initiations and buybacks wake up sleepy stocks. When temporary proves temporary, recovering earnings become the catalyst themselves. When coverage finally arrives at neglected small caps, the attention gap closes, and so does the valuation gap. Sometimes the catalyst is macroeconomic, not company-specific. When the Fed pivoted on rates, the leaderboard flipped. Rate weather matters. If intrinsic value is $100 and you pay $60, that's a 40% margin of safety. That cushion protects against valuation errors, downturns, and plain bad luck. The value trap. Sometimes the catalyst never comes. Some stocks are cheap for a reason. Cyclicals demand care. Trailing earnings may sit at a peak or a trough, distorting the formulas. Buy at a discount. Verify quality. Wait for the cycle. Your positioning, not hoping. If arithmetic alone won, everyone with a spreadsheet would beat the market. What separates winners is temperament, buying when Wall Street sells, waiting years, walking away. The liberating truth: a value investor doesn't need the crowd's agreement. You must grow comfortable standing apart from the herd, occasionally looking wrong in the short term. Buying what others urgently dump fights every instinct. That discomfort is the point. The discount exists because the selling feels unanimous. Value pays on its own schedule. Growth's dominance left value investors looking out of touch for a decade. The investor who endures being early collects when the cycle turns. Discipline cuts both ways. The courage to buy what's hated, and the rigor to refuse what's merely cheap. The margin of safety, 20 to 30% or more, is humility priced in. The antidote to bias is a written, repeatable process and structured checklists. When insiders' own money lines up with your analysis, conviction gets easier to hold. Your most durable advantage may be behavioral: independence, patience, discipline. The market keeps offering bargains to those who look where others aren't. Now the risks. The neglect that grows bargains can also conceal rot. Sub-$300 million companies are thinly covered because they're hard to value. Your information disadvantage is real. The value trap. Alluring low ratios masking permanent decline. Among investing's hardest calls. Even Buffett was fooled. Dexter's shoe looked cheap right up until profitability evaporated. Qualitative red flags often whisper the truth long before ratios shout it. Value can lag for years. Buying boring companies in the 2010s felt like bringing a newspaper to a gunfight. A mispricing can persist longer than a portfolio stays patient, 2 to 5 years. The 12 to 14% rewards accrue only to investors who survive the droughts. Graham's formula stumbles on cyclicals at boom time peaks, making dangerous stocks look cheap. Earnings can be legally shaped. Relying on PE alone means reading the brochure, not the blueprint. Screens nominate, They don't exonerate. Qualitative judgment resists automation entirely. Valuation happens against the treasury market. Stocks are worth less when safe yields are high. Treasury at 4.5, earnings yield at 3, you're underpaid for risk. Walk away. Mitigate with the margin of safety, multiple methods, free cash flow, and real research. The risks don't close the door. They're the toll keeping the highway clear. Finally, the practical playbook. Turning bargain hunting into a repeatable craft and demands a plan. Buffett built his early record on overlooked small caps. Lynch scoured boring corners institutions systematically avoid. The four-step workflow: cast the net, run the numbers, interrogate the story, demand a margin. Optional filters, minimum market cap, positive earnings, and cash flow steer you clear of the riskiest names. Eliminate companies with excessive debt or persistently negative free cash flow without clear explanation. Comparable company analysis against peers is often the most practical starting point for value. Insider purchases must be reported to the SEC, and they're easily tracked through data providers. Graham's bond yield adjustment, 4.4 divided by Y, ties value directly to rates. And patience is non-negotiable. 2 to 5 years for recognition. Beware attractive ratios with weak positions or questionable leadership. Traps spring. Keep expectations grounded. Intrinsic value is an estimate, never a precise number. Wonderful companies at fair prices compound value for decades. That's the end game. 12 to 14% annually, historically. The disciplined hunter's patience gets rewarded. So here's the takeaway. Buy dollars for 50 cents. Demand your margin of safety and wait. What's your favorite value screen? Drop it in the comments. I read every one. And remember, this video is for educational purposes only, not financial advice.